Building wealth with real estate can actually be quite easy if you know how the tax system works. In this video, I'm going to share with you how you can build enormous amounts of wealth in your super and why so many clients are starting to do this right now. If you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now in a second here, we're gonna jump onto the whiteboard. I wanna break down some real hard numbers, and this can still apply to you even if you're young, in your 20s and 30s, and it can go all the way up to your 50s and 60s when you are planning your retirement, looking at how you can utilize your super fund as well. Now, I'm not a financial advisor. We just have so many people approaching us right now with this idea of buying property in their super fund. They've seen their super funds deplete over the last couple of weeks as the stock markets have started to crash, and who knows where that's going to be over the next 12 to 18 months. So as a result, I thought I could just base this on facts, show you exactly what people are doing, what the richest of rich people are doing with their super funds, and you might be someone who may not be able to borrow right now because your borrowing capacity is not there. But when you go and borrow in your super fund, it is completely separate. You might be locked out of borrowing in your personal, but you might still have a chance in your super fund as well. Now, this is a decision you need to make for yourself. Is it that I want to have my money in crypto? Is it that I want to have it in shares? Or do I want to go ahead and use my super to use leverage and buy property? Well, if you're someone that's looking at property, I'm going to break down some scenarios right now and show you how you can be earning $300,000 tax-free by the time you retire. And I don't know who you are, but $300,000 is a lot of money, especially if you're not getting taxed. In today's terms, that's almost $550,000 worth of income that you would have to earn just to make that 300K. So I'm going to show you some tax advantages that you have by building wealth in super. Now, one of the key differences that you will find in my videos when I talk about buying personal or under trusts is that you can go ahead and use a 10% deposit. In some cases, even less than that. But when it comes to super, it's usually about 20%. In some circumstances, you still can do 10%, and it really depends on how savvy your broker is to get you those deals. If you need help with any of this, like finding a mortgage broker, getting an accountant to set up this, or getting a buyer's agent to find you the right properties, if you're gonna invest your super fund into property, you need to do it the right way. Because if you screw that up, you're pretty much screwed when you need it, which is when you're probably not able to work anyway. Now, one of the key differences here is that you need a 20% deposit, and the other big difference is you can't leverage the equity from one property as a deposit to purchase your next property. So if you were to purchase under your personal, you've got a property or your principal place of residence, as it goes up in value, you have some equity there. You could use that equity as a deposit for your next property. It makes it a lot easier to build wealth. In your super fund, you can't do that. So if your property grows in value and has equity, you can't extract that to purchase another property. And that's why these really rich people are going and investing in multiple assets rather than just plugging all of their money into the one property, because it gets stuck. And if you really want to go and build out wealth, I'm going to show you exactly how you do it in this video. So let's assume you're buying a property for $500,000. Your 20% deposit is $100,000. Your stamp duty and fees is probably about $30,000. And that means you will need anywhere between $130,000 to $150,000 to make that purchase. Now, could you purchase something for $450K? Yes. Could you go and purchase something for $700K? Yes. But you need to know where the sweet spot is for you getting capital growth as well as that cash flow. And as we know, when we retire, we need strong cash flow. So if you're going into an area just hoping that it grows, well, firstly, hope is not a strategy. And secondly, you're gonna need to rely on strong rental growth and income from that area. So that's why this strategy actually works when we find the right properties. So I'm gonna use an example here, Kevin and Anna, who are in their 40s, and they're considering using their $300,000 combined to go and purchase property. In this case, they would be able to go and purchase two properties. And what the numbers actually look like are a $502,000 purchase and a $455,000 purchase. That means the total asset value is now $957,000. A lot more than the initial $300K they started with, but we have debt in this situation. Now, this will also leave about $50,000 left in their SMSF. Something to note, and this is why you need the right brokers, some banks and lending institutions require you to have a liquidity buffer. And that means that even if you have all the funds and you have the capacity, if you don't have the funds remaining outside of your purchases, they won't actually approve your loans. So that's something to consider as well. Now, I'm using very conservative numbers here of 5%. When you look at real estate, it grows anywhere between 6 and 8%. If you look at the results we have at Search Property, it's closer to 11 to 13%, but I'm being conservative here at 5%. Let's say 10 years have passed. This couple actually holds on to their properties. The value of the portfolio would now be worth over $1.5 million. If they held for 20 years, so an extra 10 years, it would now be worth $2.5 million. Now, significantly more if they had just kept their money in their super account, trying to keep it in the markets. If you did a comparison of two, this would definitely outweigh the gains that you would get. Now, in 20 years, it should actually be paid off because you'll have the rent that comes in plus your employer contributions as you work. So by the time this couple is in their 60s, in the 20 years they've been investing, just after 2 purchases, which they would make in the first 12 months, they do absolutely nothing else. That would mean that their portfolio is worth $2.5 million. And if their rental yield is a conservative 4%, that means they make $101,000 every single year. Now that's still far from the $300,000 you probably saw on the title or the thumbnail. So what are we doing here? Now, if you were to look at the same scenario, if you just have it invested just like everyone else, you're looking at probably earning about $29,000 from the same amount of money at that point. If you compare that to here, you're making almost 3x more in rental income, so cash flow in general. And you now also control asset values of $2.5 million across 2 assets. That's going to continue growing, so you'll still have equity building as well as the cash flow that you get as well, and that's going to grow much faster than anything else. Now, some of the things that you would want to consider are the ongoing costs. The rent is going to grow faster, and the capital growth will be faster than this. I've used conservative numbers here just as a baseline to show you the example. Now, if we want to get to 300K, so this is level 1. Most people should be happy with level 1. If we want to get to level 2, what does that look like? Well, I'm glad you asked. The bonus here is that yes, we can't use equity to buy again. However, after 10 years, this couple can go and sell their 2 properties, which is worth $1.5 million. The debt on these properties would be about $800,000. That means the equity is about $750,000. So after you sell both, the costs and the taxes that you incur, you're left with about $600,000. So even in this example, if you said, okay, I just want to supercharge my portfolio, I'm only going to do this for 10 years and then I want to be conservative. I just want to put that money in the bank. I don't want it in stocks. I don't want it in property. You could go and do that. And now your balance would have grown 2x in those 10 years. But if the idea is to go and build wealth further in real estate, you could use the $600,000 and rinse and repeat the process. You would purchase another 4 properties and that would now be worth about $2 million. At 5% yield, you're still getting $100,000, but now you have a larger asset base, which is about $2 million. So if you did that and then waited another 10 years, so now you're 60 because you did this in your 50s, you would now have a portfolio worth $3.2 million, and at a 4% yield, it's $128,000. So an extra $20,000 plus an extra $700,000 to $800,000 worth of net asset value that's going to continue going up in value as well. So in this example, what we've done is we've gone from 2 properties worth 2.5 million, making 100K, to now 4 properties worth 3.2 million, making $128,000. Still far from our 300K. And this is why it's very important you pick the right properties, get the right numbers involved, and you have the right vision to execute this. Now, here we go. Could we go and repeat this process? Absolutely. We could go and do this in our 20s or 30s and we'll have much more room to grow this. We could also go and sell and save the cash in the bank, which means now I don't want to be invested in markets. I have a lot more cash there. It's a safer play. Or you could sell, diversify, and potentially sell 2 properties and pay off your principal place of residence. So imagine you get to your 60s and you're like, okay, I've got these 4 properties, they've grown in value. I've also got about 500K worth of debt on my principal place of residence. What you could do is use the savings from there. Once you've retired, you could take that money, pay off your principal place of residence. You then still have enough cash flow coming in to satisfy your lifestyle, live very, very comfortably, and you'd have your house paid off as well. Now, here is the kicker: tax. You need to understand how taxes work in your super versus outside of your super. Now, so when we are working, everything we make is taxed at about 15%. So what I mean by that, if you're earning a rental income, you get taxed at maximum 15%. You compare that to outside of your super, you'll get taxed in line with your marginal tax rate. So if you're in the highest bracket, that could be as high as 47%, which is 3x what you have in your super. Now, here is the kicker. When you stop working, you pay absolutely no tax. This is an incredible way to build enormous amounts of wealth, because what you will find is you will be earning all this income, and maybe it's $150,000 to $200,000. That's equivalent to you going and saying, well, I have to make almost double that to be able to make that income as net income because I get taxed so much. So when you're getting taxed 0%, this is why it's so important you understand taxes, you understand who's going to do your mortgages and who's going to buy you these properties. Because you could get any of these three wrong and this system completely falls apart. Your retirement is in jeopardy. And that's why you need to have the right team to be able to execute on this. Now, in this case, we looked at someone who started in their 40s and they get to a place where they've got net assets worth over $3 million. They've got potentially their house paid off. They're making about $120,000 a year. It's a very good place to be. And then knowing you're not going to get taxed is incredible. But if you happen to start this only 10 years earlier than that, in your 30s, you will well and truly be on your way to making $300,000 net passive income from your investment portfolio. You get to that age, you're not wanting to work. But think about how many other people you know right now that are in their 50s, 60s, 70s, and maybe even 80s that are struggling because they didn't think about this stuff when it really mattered. So if you're young and you're looking at building wealth, you have a vehicle right there if you want to. So I urge you to go and do some more education around it, learn from the people, and if you just want to chat to our team around how this could work for you, because we do it with so many clients, I'll leave a link in the description box below. You book in a free call, we do the strategy session, and we execute everything. So if you need help, reach out. If you guys have enjoyed this video, subscribe, and I'll catch you guys in the next one. Thanks, guys.